CVS is a stock that I used to own in my portfolio. It was my second or my third largest position. I gained many followers from talking about CVS before. I was very bullish on the stock. I loved it. And as I told you guys, I sold it before pre-market last year around $82, $83. Once the management started revising guidance, I believe I got out at break even or I lost like 1 or 1.5%. And since then, the management has been absolutely terrible. The stock is trading at $55 per share, the same price it was trading at in 2013. And the question is CVS right now an amazing buying opportunity with a 5% dividend and like a 40% payout ratio? Or is it just a value trap and it's going much, much lower? Maybe like Walgreens is going to $10 or something. I mean, you never know. Walgreens went from $100 to $10 and it just didn't play out. So the question is CVS a good opportunity or is it just a value trap? And it's been a terrible year for the stock. It's down over 30%. I mean, most companies are up this year. Any company is pretty much green except CVS and a few others. And it's down, 30% year to date. Absolutely terrible. Last earnings weren't too bad at all. They did beat on EPS, $1.83 versus $1.73. They missed a little bit on revenue, but nothing crazy. But there were a lot of bad news. The first kind of bad news you could say is Aetna's president is stepping down and he's going to leave the company immediately based on the current performance and outlook of the segment. So main reason I used to like CVS over Walgreens was because CVS had Aetna, which is their insurance exposure, and it provides them with premium and it's a pretty steady income that has been increasing. It's been a cash flowing machine. It was a very good acquisition from CVS, I believe, in 2018. And that's why I like CVS over Walgreens. But even now, Aetna's insurance, CVS, is struggling too. And it's very, very bad. It used to make up for the pharmacies that are struggling, but now this arm is also struggling. And, the CEO of CVS, Karen Lynch, will also take over the management of Aetna. And it's getting really messed up. It's very, very bad. And the company is losing its edge in many different places, like Tyson Food. In January, it dropped CVS Caremark and instead it shows something PBM startup right away to manage drug benefits for 140,000 employees instead 2024. This is a big loss. Another one a lot of you heard about is the Blue Shield of California, one of the largest insurances in the United States. It also dropped Caremark for Amazon Plus Pharmacy and some companies that's ran by Mark Cuban. And a lot of companies are leaving CVS. Now, CVS is, of course, adding some customers, but a lot of them are leaving too. And Caremark is struggling. Aetna is starting to struggle. And that was the main bright point investing in CVS. And if Aetna continues to struggle, then it's going to be very, very bad. They also revised guidance down again. And this is why this is initially why I sold CVS. When I first owned the stock, my main thesis was based on their guidance. Once they acquired Aetna, they did the Oak Street Health, Signify Health acquisition, took on a lot of that. My main case was that if they do meet this guidance, and back then they were actually beating guidance. So I saw, if they get to $10 EPS by 2025, and that's like 15 times earning. This is $150. I was buying the stock for like 78, with a dividend and all that kind of stuff. I can get it double in 5 years or in less than 5 years, in like 2 to 3 years on something like CVS. And once they lowered guidance for 2024, it was like $9. They lowered it to $8. This is when I exited pre-market because I knew it was just most likely going to go downhill. And now the guidance for CVS for earnings per share is around $6.40 to $6.65. I mean, I couldn't believe it. This is for 2024. $6.40 from $9 to $6.40. How bad is that? How bad could you be for you to miss on it that much? I mean, from $9 to $6.40. And I thought they were being conservative with $9, but I was completely wrong. And that's why I, ended up trying to correct my mistake before it gets worse. That's what I try to do. Once I feel like I'm wrong and things aren't heading the right way, I just get out and move on. I don't marry stocks or anything. Cash flow is still, somewhat stable from 10.5 billion to 9 billion. Of course, it's down, but it's not nothing too crazy. It's still very strong free cash flow. And based on this strong free cash flow, CVS right now is trading at a 12.6% forward free cash flow yield, which is, on a $9 billion cash from operation, 3 billion capital expenditures, they're left with some free cash flow, and it's around a 12.6% free cash flow yield. This is a massive free cash flow yield on CVS. And if you notice, despite the stock going down from like $80 to like pretty close to 55 right now, the free cash flow yield is still in the 12 to 13%. And this is because they had to revise guidance so much, so the stock didn't really get cheaper. It's still trading at the same exact multiple because the free cash flow yield has gone down with the stock price. So this is very important to know. And 12.6% free cash flow yield, the dividend is 5%. I believe for now, the dividend is safe. They pay 5%. They're left with 5 to 7%, I should say around 7% of a free cash flow yield, and they have nothing crazy in terms of maturities. They do have, some of them, but I mean, nothing too crazy in the short term, like $2 billion a year to $3 billion a year. CVS could easily pay it off as long as the free cash flow doesn't get worse. If this is really the bottom on CVS, and I thought it was the bottom a long time ago, but if this is the bottom on cash from operations, I don't believe the dividend will be cut. So for now, the dividend payout ratio is like 40% or 38%. It's very safe. So I think, the dividend is safe. The analysts are pricing in a massive recovery in free cash flow from 8.5 to 9.5, 11.6, 12.6, 14.5. But this has been the case for a while. And these estimates, they keep coming down. And I saw the same estimates for Walgreens. And look where Walgreens is. So sometimes we can't just depend on what the analysts are saying. But for me personally, the way I look at it is if CVS can sustain the free cash flow, and if it's not going to grow again, then at 12.6% free cash flow yield, I mean, that's what I would expect in terms of a return. So if they never grow free cash flow, if everything stays the same, I would expect a return pretty close to 12.6%. And I have to say, as someone that not only invests in compounders and quality stocks, I also invest in a lot of turnarounds. I would be willing to bet on CVS at a turnaround with the metrics, but I cannot bet on CVS because of the management. The management has been messing up. They were too optimistic in guidance from $9 to $6.35. I mean, this is very, very bad. You have other CEOs, like the CEO of Hims, for example, and Palantir and other CEOs. What they try to do is they try to be too conservative so they can actually beat the numbers and help the stock price and just be more conservative in terms of expectations. But I don't really trust the management of CVS, and that's why I'm not willing to bet on the stock, even though it's trading at $55 per share. The stock is attractive. The metrics are telling me the stock is a buy, but I just can't go with this management. If we do have different management or some activists, maybe. But for me personally, I'd rather buy, other opportunities here. A lot of the big tech stocks are down, and that's what I'm trying to look at to allocate my own capital. And this is my opinion on CVS, not financial advice. Thank you for watching. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.